I'm about to tell you something that's going to save you from making a catastrophic mistake. Right now, there are 5 stocks sitting in portfolios across America that people think are safe, reliable investments. They're not. In fact, I've been quietly selling out of these positions over the past few months. And if you own them, you should be doing the same thing. I don't say this lightly. I've been investing for over 40 years. I've built companies worth hundreds of millions. I manage billions in assets. And I can tell you with absolute certainty that these 5 stocks are headed for trouble. The warning signs are flashing red. But most investors are either too stubborn or too blind to see what's coming. I'm Kevin O'Leary, and today I'm going to walk you through exactly why I'm dumping these positions, what the specific risks are, and what you should be buying instead. This isn't speculation. This isn't fear-mongering. This is cold, hard analysis based on fundamentals, market trends, and decades of experience. By the time you finish watching this, you'll understand why holding on to these stocks is like staying in a burning building because you're too attached to the furniture. Let me start with the first stock I've been selling, and this one is going to shock a lot of people because it's been a darling of income investors for years. I'm talking about AT&T. Yes, the telecommunications giant, the company that pays a fat dividend and that financial advisors have been recommending to retirees for decades. I've been dumping my AT&T shares, and here's exactly why you should too. AT&T is a melting ice cube. The business model is fundamentally broken, and no amount of dividend payments can fix structural decline. Let me explain what I mean. AT&T operates in 3 main businesses: wireless service, broadband internet, and media entertainment. All 3 of these segments face massive headwinds that aren't going away. The wireless business is commoditized. There's no pricing power. Customers switch carriers based on whoever offers the cheapest plan. AT&T, Verizon, and T-Mobile are in a race to the bottom on pricing. They're all offering essentially the same service. Same network quality, same coverage, same speeds. The only differentiation is price. And when your only competitive advantage is being cheaper, you're in a terrible business. Look at AT&T's revenue growth over the past 5 years. It's been essentially flat. Some quarters up slightly, some quarters down slightly, but no meaningful growth. For a company this size to generate 0 revenue growth tells you the market is saturated. There's nowhere left to expand. They can't raise prices because customers will switch. They can't add significant new customers because everyone who wants wireless service already has it. Now let's talk about their debt. AT&T is sitting on over $130 billion in total debt. That's an obscene amount of leverage. Their interest expenses alone are running at about $6 billion a year. Think about that. They're paying $6 billion annually just to service their debt, not even paying down the principal. That's $6 billion. That can't be invested in the business, can't be returned to shareholders, and can't be used to compete more effectively. Why do they have so much debt? Because they made one of the dumbest acquisitions in corporate history. They bought Time Warner for $85 billion in 2018. The logic was that they needed content to differentiate their distribution. It sounded good in the boardroom. It was a disaster in execution. The media business is a terrible business. It's hit by cord cutting, streaming competition, and changing consumer behavior. Traditional cable TV is dying. Advertising revenue is migrating to digital platforms like Google and Facebook. The entire media landscape is being disrupted. So what did AT&T do? They spun off their media assets, combining them with Discovery to create Warner Brothers Discovery, essentially admitting the acquisition was a mistake. But the debt from that acquisition, still on AT&T's balance sheet. They paid $85 billion, destroyed shareholder value, spun off the assets, and kept the debt. It's financial malpractice. Here's what really concerns me about AT&T, the dividend. Everyone loves AT&T for the dividend. It yields over 6%. Sounds great, right? Wrong. That dividend is a trap. When AT&T spun off Warner Brothers Discovery, they cut their dividend by almost 50%. Shareholders who were counting on that income for retirement got crushed. Their income was cut in half overnight, and Here's the thing. The dividend could get cut again. AT&T's payout ratio, the percentage of earnings they pay out as dividends, is uncomfortably high. They're paying out most of their free cash flow as dividends, which means they have very little cushion. If their business deteriorates even slightly, if they face unexpected expenses, if interest rates rise and their debt becomes more expensive to refinance, that dividend is at risk. I don't invest in companies where the dividend is at risk. Income investors buy AT&T because they want reliable growing income, but AT&T can't grow the dividend. They're struggling just to maintain it, and the risk of another cut is very real. Why would I own a stock with zero growth, massive debt, and a dividend that could get slashed at any moment? I wouldn't. That's why I sold. Let me move to the second stock I've been dumping, and this one is going to upset a lot of people who think they're investing in America's future. I'm talking about Ford Motor Company, the legacy automaker that everyone thinks is going to win the electric vehicle revolution. They're not. And holding Ford stock is a bet that's going to end badly. Ford is trapped between two worlds. They're trying to maintain their traditional internal combustion engine business while simultaneously investing billions in electric vehicles. And they're failing at both. Their traditional business is being squeezed by competition, rising costs, and changing regulations. Their EV business is burning cash and losing market share to Tesla and Chinese competitors. Let's start with the fundamentals. Ford's operating margins are terrible. They're running around 5 to 7% in good years. Compare that to Tesla, which has operating margins in the teens. Why the difference? Because Ford is saddled with legacy costs that Tesla doesn't have. Massive pension obligations for retired workers. Expensive union labor contracts. Decades-old factories that are inefficient and outdated. Dealer networks that add cost and complexity. Tesla builds cars in modern factories with non-union labor and sells directly to consumers. Ford builds cars in old factories with expensive union labor and sells through a dealer network that takes a cut of every sale. Guess who has the structural advantage? It's not even close. Now let's talk about Ford's EV strategy. They've announced they're investing $50 billion in electric vehicles over the next few years. Sounds impressive. But here's the problem. They're way behind. Tesla has a decade head start. They've figured out battery technology, manufacturing efficiency, software integration, and charging infrastructure. Ford is starting from scratch on all of those things. Ford's Mustang Mach-E is a decent car, but it's not competitive with Tesla's Model Y on price, performance, or range. The F-150 Lightning is interesting, but production has been plagued with problems and demand hasn't met expectations, and the charging infrastructure for non-Tesla EVs is a mess. Finding a working charger that's compatible with your Ford EV is frustrating and unreliable. Here's the bigger issue. Ford is losing billions on every electric vehicle they sell. Their EV division lost over $4 billion last year. They're selling EVs below cost to gain market share. But this strategy only works if you eventually achieve scale and bring costs down. I don't see how Ford gets there. Tesla has scale, and they're still struggling with profitability on some models. How is Ford, with higher costs and less experience, going to make money selling EVs? The answer is they're not, at least not for many years. And in the meantime, they're burning cash, taking on more debt, and falling further behind competitors. Their stock price has gone nowhere for years because the market understands this reality. There's no growth, there's no competitive advantage, there's just a legacy company trying desperately to transform itself and failing. I sold all my Ford shares because I don't invest in hope. I invest in businesses with clear paths to profitability and competitive advantages. Ford has neither. They're going to continue bleeding cash on EVs while their traditional business slowly declines. That's not an investment. That's a value trap. The third stock I've been selling is going to surprise people because it's in a sector that I generally love. I'm talking about Walgreens Boots Alliance, the pharmacy giant, and I'm dumping it because the entire business model is broken beyond repair. Walgreens operates over 8,000 pharmacies across America. They fill prescriptions and sell front-of-store retail products. Sounds like a stable, recession-resistant business, right? It's not. The pharmacy business is under attack from every direction, and Walgreens is losing on all fronts. First, let's talk about pharmacy reimbursement rates. Walgreens gets paid by insurance companies and pharmacy benefit managers, or PBMs, every time they fill a prescription. Those reimbursement rates have been declining for years. The PBMs have consolidated into three giant companies that control about 80% of all prescriptions in America. They have massive bargaining power. They dictate terms to pharmacies. And those terms have gotten worse and worse. Walgreens is essentially a price taker. They have no negotiating leverage. If they don't accept the PBM's terms, the PBM will direct prescriptions to competitors. So Walgreens accepts lower and lower reimbursement rates, which crushes their margins. Their pharmacy margins have been declining for years, and I see no reason that trend will reverse. Second, mail-order pharmacies are taking market share. Why go to Walgreens when you can have your prescriptions delivered to your home for free? Companies like Amazon Pharmacy and prescription delivery services are making the trip to the pharmacy unnecessary, especially for maintenance medications that people take every month. Why would you drive to Walgreens, wait in line, and deal with parking when you can have it delivered to your doorstep? Third, the front of store retail business is dying. People don't shop at Walgreens for toothpaste and shampoo anymore. They buy that stuff at Walmart, Target, or Amazon where it's cheaper. Walgreens retail business has been declining for years. They're losing market share to everyone, and their stores are depressing. Old, poorly maintained, with limited selection and high prices. There's no reason to shop there. Fourth, Walgreens made a catastrophic acquisition. They bought a significant stake in Village MD, a primary care clinic operator, for billions of dollars. The strategy was to put doctors' offices inside Walgreens stores and create an integrated healthcare experience. It was a disaster. The clinics lost money, patients didn't show up. The integration was a mess. And Walgreens ended up writing down billions in value, admitting the investment was a mistake. Now let's talk about the numbers. Walgreens' revenue has been flat to declining. Their earnings have been cut in half over the past few years. Their stock price has fallen from over $80 in 2015 to around $10 today. That's an 87% decline. And they cut their dividend, which was supposed to be their main attraction for income investors. The company is in full crisis mode. They're closing hundreds of stores. They're cutting costs. They're trying to restructure. But I don't see a path forward. The fundamental problem is that their business model doesn't work anymore. Pharmacy margins are too low. Retail is dying, and they don't have a competitive advantage in anything. I sold Walgreens because I don't invest in businesses that are in structural decline. No amount of cost-cutting or restructuring can save a business when the entire industry is being disrupted. Walgreens is a melting ice cube, and I'm not going to hold it while it melts. Let me talk about the fourth stock I've been selling. And this one is controversial because a lot of very smart investors own it. I'm talking about Intel, the semiconductor giant, the company that dominated the chip industry for decades. I've been dumping my Intel shares because they've lost their competitive edge, and I don't see them getting it back. Intel's problem is simple. They fell behind on manufacturing technology, and catching up is going to cost tens of billions of dollars with no guarantee of success. For decades, Intel had the best chip manufacturing in the world. They made the fastest, most efficient processors. They had a technological moat that competitors couldn't cross. That moat is gone. Taiwan Semiconductor Manufacturing Company, or TSMC, is now the leader in advanced chip manufacturing. They're producing chips on 3 nanometer and 5 nanometer processes that are smaller, faster, and more power efficient than anything Intel can make. Apple, AMD, NVIDIA, Qualcomm, they all use TSMC for their most advanced chips. Intel has lost its technological advantage. Intel's response has been to announce massive investments in new manufacturing facilities. They're spending over $100 billion building fabs in the United States and Europe. The goal is to catch up to TSMC and regain their manufacturing. Leadership, I don't think it's going to work. Building semiconductor fabs is incredibly expensive and incredibly risky. You're spending billions of dollars on facilities that take years to build and might be obsolete by the time they're operational. The technology changes so fast that what's cutting edge today might be outdated in 3 years. Intel is betting $100 billion that they can catch up to TSMC. That's a huge bet with uncertain returns. Meanwhile, Intel's core PC business is shrinking. The PC market is mature, sales are declining or flat. The growth in computing has shifted to mobile devices, data centers, and AI chips. Intel has been slow to adapt to all of these trends. They missed mobile completely. Apple, Qualcomm, and ARM-based chips dominate smartphones and tablets. Intel has essentially zero market share. In data centers, Intel is losing share to AMD. AMD is using TSMC's advanced manufacturing to produce chips that are more powerful and more efficient than Intel's offerings. Major cloud providers like Amazon and Microsoft are increasingly choosing AMD chips for their data centers. Intel's dominant market share in server chips is eroding. In AI, Intel is getting crushed by NVIDIA. AI workloads run on GPUs, not CPUs. NVIDIA has over 90% market share in AI chips. Intel tried to compete with their own AI accelerators, but they're years behind NVIDIA's technology. The AI boom, which is the biggest growth opportunity in semiconductors, is happening without Intel. So Intel is losing in PCs, losing in data centers, missing in mobile, and irrelevant in AI. Their response is to spend $100 billion building new fabs and hoping they can catch up. That's not a strategy I want to invest in. The risk is enormous. The timeline is years, and there's no guarantee of success. Intel's stock has gone nowhere for years, while NVIDIA, AMD, and TSMC have all soared. The market understands that Intel is in trouble. Their margins are declining. Their market share is eroding. Their growth is negative, and they're making massive capital investments that might not pay off. I sold my Intel shares because I don't invest in turnaround stories with uncertain outcomes and massive execution risk. I invest in companies with clear competitive advantages and visible paths to growth. Intel has neither. They're a fallen giant trying to reclaim past glory, and the odds are against them. Now let me talk about the fifth and final stock I've been selling, and this one is going to make a lot of dividend investors angry. I'm talking about 3M, the industrial conglomerate, the company that makes everything from Post-it notes to medical equipment. I've been dumping my 3M shares because they're facing massive legal liabilities that could destroy shareholder value. 3M is being sued by hundreds of thousands of people over two main issues. First, defective earplugs sold to the military. Second, PFAS contamination, also known as forever chemicals, in drinking water across the country. The potential liability from these lawsuits is in the tens of billions of dollars. That's not speculation. That's based on actual settlement amounts and jury verdicts. The earplug litigation is already costing 3M billions. They've lost multiple jury trials. Juries have awarded hundreds of millions in damages, and there are still over 200,000 pending cases. 3M tried to use bankruptcy to limit their liability, but courts rejected that strategy. They're going to have to pay. The total cost could easily exceed $10 billion. The PFAS litigation is even more frightening. PFAS are chemicals that 3M manufactured for decades and that have contaminated water supplies across America. These chemicals don't break down. They persist in the environment forever, and they've been linked to cancer and other serious health problems. Thousands of municipalities and water districts are suing 3M for the cost of cleaning up contaminated water. 3M has already agreed to pay over $10 billion to settle some of the PFAS claims. But that's just the beginning. There are thousands more potential plaintiffs. The cleanup costs could run into the hundreds of billions, and 3M's insurance might not cover all of it. The company could be on the hook for liability that dwarfs their market capitalization. Beyond the legal issues, 3M's core businesses are struggling. They operate in mature, slow-growth markets. Industrial adhesives, abrasives, healthcare products. These are all commoditized products with limited pricing power. Revenue growth has been anemic. Margins have been declining. The company is cutting costs and restructuring, but that only gets you so far. 3M recently spun off their healthcare business into a separate company. The logic was to unlock value and allow each business to focus on its own strategy. But what really happened is 3M kept the legal liabilities and spun off one of their better businesses. Shareholders got stuck with the declining industrial business, and the massive lawsuit exposure, the dividend is at risk. 3M has been a dividend aristocrat, raising their dividend for over 60 consecutive years, but they recently cut the dividend for the first time in decades. Why? Because they need cash to pay legal settlements, and there are more cuts coming. As the legal bills mount, 3M is going to have to choose between paying dividends and paying settlements. Guess which one wins? I sold all my 3M shares because I don't invest in companies with massive, unpredictable legal liabilities. I can model revenue. I can model margins. I can model competition. But I can't model how a jury is going to rule in a lawsuit. The downside risk is too high. 3M could be forced to pay tens of billions in settlements that destroy shareholder value. Why would I hold that risk? Now that I've explained the 5 stocks I'm selling, let me tell you what I'm buying instead. Because selling is only half the strategy. You need to redeploy that capital into better opportunities. And there are better opportunities if you know where to look. I'm rotating out of these broken business models and into companies with strong competitive advantages, growing markets, and sustainable cash flows. I'm buying more Visa and MasterCard. These are duopoly businesses with incredible economics. Every time someone uses a credit or debit card, Visa and MasterCard take a small cut. As the world moves away from cash, their transaction volumes grow. They have no inventory, no manufacturing, no physical products, just software and networks. The margins are obscene, over 50%, and the growth is steady and predictable. I'm buying more Microsoft. They dominate productivity software with Office. They dominate operating systems with Windows, and they're becoming a major player in cloud computing with Azure. Their business is incredibly sticky. Once companies are using Microsoft products, they don't switch. The switching costs are too high. Microsoft has pricing power. They can raise prices and customers pay because the products are essential. That's the kind of business I want to own. I'm buying more Alphabet, the parent company of Google. They dominate search advertising. They dominate video with YouTube, and they're a leader in cloud computing. Google search has over 90% market share. That's a monopoly. And it's incredibly profitable. Advertisers have to buy Google ads because that's where the customers are. YouTube is the second largest search engine in the world after Google itself. The combination is unbeatable. I'm buying more Costco. They have a business model that's recession resistant and built on customer loyalty. Costco charges membership fees for the right to shop in their stores. Those membership fees are almost pure profit, and the renewal rate is over 90%. That tells you customers love the value proposition. Costco keeps prices low, which drives traffic, which allows them to negotiate better deals with suppliers, which allows them to keep prices even lower. It's a flywheel effect that competitors can't replicate. I'm also adding to my positions in utilities and infrastructure companies. Boring businesses that generate steady cash flows and pay reliable dividends. Companies that own power plants, pipelines, toll roads, and cell towers. These are assets that aren't going anywhere. People need electricity. They need natural gas. They need roads. They need wireless service. And these companies get paid whether the economy is booming or in recession. The strategy here is simple. I'm selling businesses with structural problems, massive debt, declining markets, and uncertain futures. And I'm buying businesses with competitive moats, pricing power, growing markets, and predictable cash flows. I'm moving from complexity to simplicity, from risk to safety, from hope to certainty. Let me address the obvious question. If these 5 stocks are so bad, why do so many professional investors still own them? Why do financial advisors still recommend them? The answer is simple. Inertia and ignorance. Most financial advisors are salespeople, not investors. They recommend what's familiar and what pays them. Commissions. AT&T and 3M have been blue chip dividend stocks for decades. Advisors recommend them because they've always recommended them, not because they're good investments today. Professional fund managers often can't sell even when they want to. They're constrained by mandates and benchmarks. If you're managing a dividend income fund, you basically have to own AT&T and 3M because they're in the dividend indexes. Even if you know they're bad investments, you can't deviate too far from the benchmark or you risk losing clients. So fund managers hold these stocks knowing their problems and hoping they don't blow up too badly. Individual investors hold these stocks for emotional reasons. They bought AT&T 10 years ago when it was paying a 7% dividend. The stock is down, but they keep holding because they don't want to admit they made a mistake. They keep collecting the dividend and telling themselves it's an income investment. Meanwhile, the stock keeps falling and the total return is terrible. That's called anchoring bias, and it destroys wealth. Others hold because they inherited the stocks from parents or grandparents. They feel sentimental about holding the same investments their family held, but sentiment doesn't pay the bills. If a stock is a bad investment, sell it. I don't care who bought it or when. All that matters is whether it's a good investment today. Here's the hard truth that most investors don't want to hear. Past performance is irrelevant. It doesn't matter that AT&T was a great investment 20 years ago. It doesn't matter that 3M was a dividend aristocrat for 60 years. All that matters is what happens from this point forward. And from this point forward, these 5 stocks are poor investments, with more downside than upside. Let me give you a framework for evaluating your own portfolio. Take every stock you own and ask yourself 3 questions. First, if I didn't own this stock today, would I buy it at the current price? If the answer is no, sell it. Don't hold stocks you wouldn't buy. That's irrational. Second, does this company have a sustainable competitive advantage that will protect it for the next 10 years? If the answer is no, sell it. Investing in companies without moats is speculation, not investing. Third, are the financials improving or deteriorating? Is revenue growing? Are margins expanding or contracting? Is debt manageable or ballooning? If the trends are negative, sell it. Don't hold deteriorating businesses hoping they'll turn around. When I apply this framework to AT&T, Ford, Walgreens, Intel, and 3M, they all fail. None of them pass the tests. That's why I sold, and that's why you should too. I want to be crystal clear about something. I'm not saying these companies are going bankrupt tomorrow. They're large, established companies with real businesses and real cash flows. They'll probably survive, but survival isn't the standard for investment. I don't invest in companies just because they'll survive. I invest in companies that will thrive, companies that will grow, companies that will generate strong returns for shareholders. These 5 stocks are dead money at best and value traps at worst. Your capital is precious. Every dollar you have invested in a mediocre stock is a dollar that's not invested in a great stock. The opportunity cost of holding bad investments is enormous. If you had sold AT&T 5 years ago and bought Microsoft instead, you'd be up over 200%. That's the cost of holding on to bad stocks.